Stock market got clobbered today, only the second day into the fourth quarter, yet Wall Street is saying forget about it. Bears are ruling the street right now, and it doesn't seem like the selling is going to be stopping anytime soon. Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and hot Scottsdale, Arizona.
It's cool, it's 62
cool?
degrees, for crying out loud. Cool down.
You know what you have to do? Start sending me the forecast report before we do these shows so I know what to say, because it could be snowing for all I know. I'm still always going to say sunny and hot. But regardless, we have somebody who is hot, who is actually going to be telling us everything we need to know. He has been on everything on CNBC. He's actually canceled a CNBC appearance today just to be here with you on Buy, Hold, Sell. Bob Elliott. He is the Chief Investment Officer of Unlimited Funds.
Hey, thanks so much for having me.
Now, Bob, I want to start with you here because going through, you're very, you have a very big presence on Twitter. You're definitely not shy on sharing your thoughts about the current market. That you just give a great perspective on everything. What's your take, though? Because everybody we've had on this show, or most people we've had on this show, have been very optimistic about what to expect in the fourth quarter. You seem to be on the other side of the trade here. Do you think this selling is going to be continuing, at least in the short term?
Well, I think we basically are in a classic late cycle dynamic, which is often when you see bond yields start to rise, those bond yields rising affect asset prices, which is essentially what we've seen, over the course of the last couple weeks and quite acutely today. And as those asset prices decline, that creates a weakness in demand and a weakness in economic activity, and is self-reinforcing on the downside as a function of it. And so given the circumstances that we're seeing, I think, there's a significant risk here that we're going to have that sort of reinforcing downward dynamic. And I'd emphasize it's happening at a time when stocks are actually getting more expensive, not less expensive. Today, stocks are more expensive than they were, say, at the beginning of the third quarter, when stocks started selling off, right? And that's very
multiple. What multiple? EPS multiple?
No, just very simply, if you think about it, like stocks are earnings discounted by discount rates, and discount rates can be understood. The value of the impact from discount rates can be understood by the performance of the long end bond yield, right? Long-term bonds are down much more so than stocks. Stocks are down 9%. Long-term bonds are down 15% since the peak in stocks. What that means is stocks are more expensive today than before they started falling. And that's a very confusing thing for many investors. How can stocks be going down and getting more expensive? It's because they're not falling enough given the bond yield moves that we've seen.
Okay. Hey, Todd, I think he makes a great point. I have a lot of subscribers who are do-yourself investors. And it's times like these when it's very hard to describe that, the bond prices is a discounting mechanism, blah, blah, blah. But the first question they said, well, why didn't it matter a month ago or 2 months ago? Because rates were certainly, had already gone up 450 basis points. How are we having we did have a little AI mania, and that, gave maybe the last gas. We are trying to price that out. But Bob, in your mind, we certainly have the technicals here. 3,800 is sort of the next stop, and then 3,600 on the S&P is sort of the next stop after that. What stops it? Where do you know? The VIX has done nothing, by the way, and so maybe that's the answer.
Yeah, well, I think what we got to start to see is enough of a decline in stocks to start making that trade-off between stocks and bonds make sense for investors. And when you're in a situation where bond yields are now in the 5 range, right, and earnings yields are in the 5 range, and there's a meaningful risk that you're not gonna meet those growth expectations that are priced into PEs, right? Right now, if you look at analyst earnings, they're expecting 12% earnings growth in 24, and then the same in 25. Like, that's a lot of earnings growth that is expected. Of course, analysts are always a little too rosy, but fine, forget it. Call it 10, call it 8. That's a lot of earnings growth in an environment where we're late cycle and bond yields just rose 100 basis points on the long end, right? Like, how are you going to get the economic growth that's going to be consistent with that sort of earnings growth in the future? And so that's really what has to happen is we got to start to normalize those expectations. We got to bring those PEs back to something that's much more reasonable relative to that 5% bond yield. And that's what creates the bottom in stock prices.
All right, well, two questions then. Number one, I'm sure you have a macro outlook. So can you give us your macro outlook for, North America, if you will? And then secondarily, to normalize, what price earnings ratio, what EPS you think would be back to normal, since it's been abnormal for 12 years?
Yeah, well, I think maybe starting with the second question, sure. What does a normal bottoming look like in PEs, right? You've got to start to, what do those situations typically look like? They look like 10, 12, 15 PEs. They look like typically when you've gone through a recession, you're looking at earnings compressing something like 15, 20% in a sort of non-crisis earnings drawdown. And so, what are we seeing here? Well, right now, what's priced in is earnings to go up 25%, not down, right? And we're seeing PEs, that are coming down every day at this pace, but still we're not quite in the range at the aggregate indices, right? At certainly small caps and mid caps are in the ballpark, but the mega caps are not, the S&P 500 is not close to where we are. So, if we get a couple points more down on PEs and we start to get those expectations of, in line with actually some weakness in even zero, right? Even zero earnings growth over the next couple of years, moving those expectations down, that's when we start to talk about something that's a little more plausible. And so, moving the equity markets in this recession scenario, moving into the, deep into the 3,000 range in the S&P 500 is totally plausible. In fact, it should be expected.
Wow. Well, I think Todd, he's the first guy who's actually had the stones to say that we have to have some return to normal. What I'm finding interesting, was a couple things. One is I just did the math yesterday on the cash reserves of, let's say, the top 10 tech stocks, and then I put a 6% corporate yield on it, and they're generating about $3.5 billion a month in free cash flow just from the yield that they never used to get. And to me, that is offsetting, the other negative for the global companies is the strength of the dollar. It seems to be sort of at repatriation of profits, but this extra $3.5 billion a month in cash flow. Now the second thing is, they are the most trustable beings out there, meaning that so much of their revenue is on subscription, it's recurring, it's very high margin. There's, the incremental cost of new customers basically zero. And they're the lifesavers right now. I mean, everything that was going on today, some of our favorite companies in the tech space were down, $3, and it's a $400 stock, that sort of bit. That to me says that it's the life raft deal that when I used to run mutual funds, when you couldn't run any place else, what was the things you could most depend on that had the strongest EPS and that had 80 or 90% of their revenues built in subscription? That to me is what the life preserver is right now. You buy it, you think I'm wrong, because at 3,000, I'm dead wrong.
Well, I just think the question is, where are you going to get that 25% earnings growth, right? Like that's, it's true. Like, do I think, I don't know, you look at Apple and sure, it's got good preservation of existing revenue stack for the reasons that you're talking about, but that's not what we're talking about on the S&P 500. That's not what the expectations are. The expectations are for a significant growth in profits, both a growth in revenue that is in the 5, 6, 7% range, and an expansion of margins at a time when labor markets are tight and we're late cycle and margins are already at basically secular highs. And so the question is not like, are these reasonable cash flow companies? Are these reasonable companies that, yes, they're definitely reasonable companies. The question is, at what price are you paying for reasonable companies? The answer is you're paying way too much in terms of your expectations for these companies that are fine and good, but are they going to meet the expectations that exist in them? And that's the real question. And that disappointment of expectations, like, I think we've sort of all are used to this like crisis dynamic. Like, that's not how most equity cycles move into decline. The way they move into decline is like everyone thinks that things are going to be great, right? Everyone looks at that, Atlanta Fed GDP now thing and says 6% real growth, it's happening. And the answer is like, well, if everyone believes that's happening and then growth is 2 or 1, then everyone's disappointed and you get the equity markets moving down. And that's basically the circumstance that I think that we're going to see. It's just, probably in the third quarter earnings reports, we're going to get disappointed. Everyone's going to get kind of disappointed relative to those expectations that were happening.
You talk about hold on, Toby. You talk about the optimism of the Wall Street consensus for earnings growth for 2024 and 2025. What's your forecast?
Well, I think, I don't pick earnings estimates in the specific, but what I'd say is conditions are aligning for economic weakness and a recession dynamic to emerge in 2024. Just essentially as everyone's given up on it. And certainly relative to expectations, we're going to have a disappointing growth environment. And I thought that, and I was pretty compelled by it, that before we had a 100 basis point run up on the long end, right? And so what are we looking at? What happens in typical recession environments? Well, certainly, zero earnings growth would be a great outcome in a recession environment. And really what people should be looking at is the possibility of meaningful negative earnings growth, right? And so
your macro is recession.
Recession, of course. Yes. Okay. Yeah. I mean, I think that's like the probability of recession today is getting higher and higher just at a time when basically, if we go back 6 or 8 weeks ago, everyone gave up on recession. And to be clear, I haven't just been a bear through this whole time. Like if you go back a year or further, I said that there was no chance that we were going to have a recession in the first part of 2023 because the cycle is much more slow moving than people expect, and the economy is going to be a lot less sensitive to interest rates than people expect. And what happened there was everyone thought there was a recession, and then it didn't come, which created everyone was wrong about that. And then what's happened, more recently is everyone expects that things will be great, just as the storm clouds are gathering for recession to play out in early 2024. And so, the expectations are just totally wrong relative to understanding the fundamental macro dynamics that are happening in the economy.
Yeah. Well, I would agree with you on this. And, we've all talked about it. We all sort of put our finger in the air and saying, OMG, is there anything of historical relevance now? Because everything is different. We're still pulling off pandemic money. We're still, we had all these various one-off situations that changed the playbook, if you will. If your playbook is that a recession is more likely than not going to happen in, next year, first half, what's the strongest reason you'd say that we're going to have a GDP recession?
Well, the main thing is if you look at the combination, basically what you have is you have a circumstance where you've had a massive tightening of interest rates, right? Interest rates the short end has gone up, the long end didn't comply. Now the long end's complying. That's then creating a hit to stocks. As stocks fall, consumers will increase their savings rate, reduce their demand. We already saw that playing out in September in the timely credit card data, even before the stock market dynamic that we've seen. And that will then, create a hit first to the most cyclical sectors and then to the broader economy and to earnings growth. And as earnings growth fades, then you get a weakening of labor market conditions and a softening of income. Like that, in a lot of ways you say, well, we've never seen something like this. A lot of us haven't seen a cycle like this in our professional lifetimes. Right. But this cycle actually is very normal. If anything, it's like very common relative to what the cycles are that we've seen during our professional lives. Like, this is very akin to cycles in the 60s and the early 70s. That's kind of what this looks like, is like a traditional late cycle environment. Those cycles, they just take a while to play out, and the economy is just even less sensitive to the interest rate rises after the period of significant stimulation. It's just, but it's normal. Like, we're seeing a normal set of cyclical dynamics play out. It's just that the people wanted it. People wanted this recession like they want their Amazon packages, like order at 9, get it at 2. It's just like not how the economy works.
I'm going to steal that one. I like that. So what you're saying is, look at, I was there in the late 70s, in the early 80s, and I was selling bonds that were.
I was not there in the early 70s.
The 1870s, Bob.
Yeah.
It's the 1870s.
No. And
but I studied it.
I would say this. If you look at the composition, I'm just going to go blow past you right there, bro. If you look at the way the indexes are now composed in the companies there, these are completely different companies than it was in 1980. I mean, we had 25% of the GDP was making products. Actually, it was 30%, and now we're 75% services. Blah blah blah. We have the Magnificent Seven represent 25, 28% of the entire S&P makeup and valuation. So for your situation to come true, to say we'll go down to 3,200, then are you really saying that? Yeah, but we got to take down the Microsofts and the Apples and the Metas and all these companies that just mint cash every essentially second of their lives? How far do they have to come down? Because you're not going to get to 3,200 unless we put a haircut on the Magnificent Seven.
Yeah, I mean, I think as a macro investor, what I'd say is that the things that you're saying about Microsoft and Nvidia and those places are not different in kind than what GE was 40 years ago, right? Like, it's just instead of creating the large scale industrial goods that GE was creating, you were creating apps and they're equivalent, they're equivalent to what's going on in the economy today. And so I think that the macro linkages, are pretty similar in terms of how the economy works today relative to how it worked in the past. And so I think you can draw those parallels. And so the question, look, here's the basic question is, if the Microsofts and et cetera, instead of having revenue growth at what's currently 12%, expected, 12%, they have it at 0, then and I should be clear, the first move here is just to reflect the interest rate move, the 100 basis point interest rate move that we've seen since July 19th. We got to get stocks into the high 3,000s, right? We're not even close to where we are there, just to reflect the change in the discount rate. Now, and at that point, we're still pricing in that 25% earnings growth over the next 2 years. So let's just cut that in half. And now we're into the mid 3,000s, right? Or a little bit lower. It's not, talking about stocks in that level, in those levels, is not we're not tilting at windmills here. This is a very plausible series of outcomes that could get us there. In fact, if anything, the re-rating of stocks are the only thing that's still up, right? Financial assets in general are actually about as low as they've been in 40 years. It's just that the stock market is the main outlier. Stocks are up 60% relative to long-term bonds over the course of the last 3 years. And given that the bonds are in the stocks, that divergence won't exist forever.
Okay. A quick question before we go to a break, Bob. This recession that you are forecasting for next year, do you see it being a quite deep recession or a mild recession?
I think odds are that this recession will be meaningfully more challenging than the vast majority of folks expect. To be clear, most folks expect no recession, right? A perfect soft landing. The markets are pricing in, by and large, a perfect soft landing. And odds are that it will be much harder than even those people who are predicting recession will believe. And the reason why that is because just as it was very hard to slow the economy because it wasn't very sensitive to interest rate hikes, so too is it hard to stimulate the economy at a time when it's not sensitive to interest rate cuts. And so in that situation, a Fed that is challenged to stimulate, and frankly, a federal government that has already spent its fiscal firepower on the economy today, puts us in a very difficult circumstance to try and stimulate as the economy starts to slow.
Yeah, I get you, Tom, where I know we're going to break. When we come back, though, one of the questions I've tried to ask all of our guests is, where does quantitative tightening fit in here? Because $95 billion, is being sold into the bond market every month by the Fed, and we never hear about QT. So, Todd.
Yeah, I love that teaser. So that's what we're going to do. So coming up after the break, we're going to talk about QT, talk all about bonds. We have with us Bob Elliott. He is the CIO of Unlimited Funds, and he will be with us right after the break. Please stay with us.
Buy, hold, sell, brought to you by Crosscheck Management.
Girl, you know it's been way too long. I got to get back in my zone.
There's something special about Friday night college football games.
When you have a Friday night college game, everybody's watching. Prime time, national audience from College Park. Friday night in the shell, nothing better.
What does it mean to be a leader?
It's taking my first solo flight.
At the University of North Dakota, we lead our own way.
Welcome back to Buy, Hold, Sell. Well, on the second trading day of the fourth quarter, we see the markets take a tumble. Actually, quite a bit. We got a big crash, actually, a panic crash, and we saw bond yields, just spike higher. We had the 10-year bond yield, treasury yield, at 4.8%, and not a lot of people had predicted that. Katie Stockton was on Buy, Hold, Sell. She gave us an exclusive, and she actually said 5.25% is where we will eventually hit. So time will tell, but right now she's right on target. But with us today is Bob Elliott. He is the CIO, Chief Investment Officer of Unlimited Funds, who was also a former investment committee member of Ray Dalio's Bridgewater. Bob, I got to ask you, real quick though, what was that like working with Ray Dalio? I'm such a big fan.
Yeah, well, it was a great place to start my career. Very proud of all the investment strategies I was able to create while I was there. Happy to be out on my own these days with that foundation, that understanding.
Yeah, that's
now
awesome.
It's like the world's biggest hedge fund. So the fund that you run now allows the non-accredited investor to invest like a hedge fund. Can you just give us a quick rundown of what your strategy is here?
I mean, the basic idea was, why should hedge fund style returns basically be available only for accredited investors and institutions? Like, why not the everyday investor? Why shouldn't they have access to these funds? And so my co-founder Bruce and I got together. Between the two of us, decades of experience having built proprietary strategies, and basically worked on a technology that allows us to replicate the positions that those hedge funds have on at any point in time, and use those and trade those in long and short positions and liquid securities that we can use to back an ETF. And the ETF structure for a lot of investors is the optimal investment structure. Plus, it means it's available to everyone. You have all the benefits of liquidity and low cost and transparency.
Yeah, well, so I'm always curious, and I just love asking this question. I ran a hedge fund, and I get all the data on a hedge fund performance. Hedge fund performance has sucked for the last 12 years, with a few outliers like Ray Dalio and a couple other ones. Stevie Cohen did okay till he wanted to buy the Mets. But typically hedge funds have trailed the market, in 5 and 10 year segments. Well, so what's your secret sauce that you don't trail the market?
Well, when you look at that, you're looking at that net of fees, and the real problem is those hedge funds are charging 2 and 20,
Right.
And the nice thing about what we're doing is we're using technology to replicate what they're doing and what their positioning is. And because we don't have to pay any star PMs, right? We're just using technology to do it. We can offer it a much lower fee structure.
That's the best answer I've ever heard. Todd, give this guy a medal.
Yeah, this is good.
I would always ask people who come to me for money management, and they were coming out of a hedge fund, and I said, "Do you really understand what 2 and 20 means?" I used to say, that the 20% is needed because the most of the PMs are on wife number 2, and they got the wife got the first house in the Hamptons, so now he's got to have another Hamptons, and he's got 4 kids in private school. So he needs that 20%. Park Avenue schools aren't getting any cheaper. And yet I've always wondered why someone couldn't replicate. And now I found it.
Yeah, there you go. I mean, that's what I like to say. Hedge funds don't have a strategy problem. The strategies are great. They have a fee problem. And the fee problem is, makes the managers rich and the investors not that much better off than what they could do on their own. But if you can replicate the strategies, right, the winning strategies, because they're very good. Like, there's a reason why the guy's got 2 houses in the Hamptons. It's not because the strategies suck. The strategies are good. It's just that they're taking all the alpha for themselves. And so that's our basic idea, is do a pretty darn good job replicating the strategies and then do it at a much lower fee structure. And then, of course, ETFs have the benefit of typically being much more tax efficient for a taxable investor. And so when you think about, the investor doesn't care about the gross of fees returns of their strategies. They care about net of fees, net of taxes. And the idea is a hedge fund replication type strategy has the advantage of fee alpha and tax alpha relative to individual manager performance that's out there.
And alpha, for people at home are not, totally into it, is just outperformance.
Outperformance, exactly.
Yeah, I could never understand why, even when I did have a hedge fund, I say, listen, guys, we're going to outperform, but unless I deliver to you at least 1.5x of what the S&P 500 is, I'm not taking the 20%, because I just couldn't look somebody in the eye and do that. But of course, I didn't have 2 houses in the Hamptons, and I've been married for 37 years, so I don't have the divorce payments. I don't have the kids in Park Avenue. So that's a great idea. I want to talk to you about doing a income fund in that same way, because I have an income strategy that has been stupid ridiculous. It would be great to be in an ETF to be highly tax efficient. So we'll talk later, darling. We'll talk later.
Conversation for another time. And
exactly.
Yeah, well, I'm sure with the pedigree that you have with Bridgewater, I'm sure this would do quite well. And the symbol for that for the audience is HFND. Terrific symbol, by the way. I don't know how you got it, but that's awesome.
Thank you.
Yeah, great for marketing. So let's turn our attention to QT. At the end of the last block, Toby brought up quantitative tightening, and he had some detailed questions about that with bonds. I'm going to ask you this question before we get to Toby's question: is how high do you see that 10-year Treasury yield going?
Well, I think we're basically in the ballpark here of what fair value is on the 10-year Treasury. We've gotten to a point where the rise in interest rates is significant enough to start to create that drag on the economy and that drag on stock prices, right? And you could see that in the intermarket action, which is that you're starting to see stocks fall, meaningfully relative to bonds. And at a 5% yield, over a long term, you're starting to see term premiums in the bond market get up to the highest level that they've been, post financial crisis, and sort of at an average-ish level, prior to the financial crisis. And given the liquidity in the system and things like that, and the high levels of that, you wouldn't necessarily expect to have a circumstance where you get to term premiums that are as extreme as they were, say, in the 90s. And so, on a value basis, what I'd like to say, look, the easy money has been made being short bonds. Like maybe they'll go a little bit higher, but the story is that they needed to move to levels that are basically in this range to start to kick off the slowing of the economy and the turning of the cycle, and that's where we're at.
So we spoke briefly about this before we went on the air about Jamie Dimon's comments regarding a 7% 10-year Treasury yield, and he had said it like you had brought up for the banks to just to be prepared in the event that we do hit that. Do you think we've even come close to a 7%, or is that just
it's Jamie
Dimon
for crying out loud? He's no macroeconomist. Hello.
Well,
Yeah,
I think he's a banker, though, and
he's a banker, and I think what he was saying, which is prudent, is that you should, if you're sitting in the bank risk manager position, you should be stress testing your book at a 7% yield, because that is a totally plausible. It's a plausible outcome. I'm not saying that it's the likely outcome or where I think we're going, but from a risk managers are paid to think about a wide range of plausible outcomes and making sure the bank doesn't blow up along the way. And so, you got to be thinking about what 7% could mean. And so that's really, I think, the way I take his advice. I think the odds that we get into that range are not that high. And the reason why that is that would imply like a pretty extreme term premium on the long end, hundreds of basis points of premium, which, would be, would almost certainly start to create dip buyers into this into the bond market, right? Yield buyers into the bond market. The other thing I'd emphasize is if you get that, that's a 250 basis point move up in the bond yield. Think about what the direct impact that will be on stocks, right? You're talking about a 25, 30%, even maybe more drag on stocks. And the point is that sows the seeds of the reasons why it would not happen, which is you start to get the stock sell-off that we're seeing, which starts to get people to look at the bond market as an attractive asset relative to the stocks, which creates the bid out of, the move out of stocks and into bonds, and essentially puts the lid on the stock price at this term premium. And so that's what you have to think about, is that they intersect each other. Like asset prices in general might be too high, but it's really stock prices are way too high and bonds are kind of in the ballpark at this point.
Yeah, I'll tell you that, the pensions that I work with, when you do the math and make the extrapolate a little bit here, that let's say 5.25 is the high end, that if you take the dividend, the interest payment, and then, your scenario plays out that we do have a reasonable mild recession. You're not talking about a headbanging recession. Then the higher for longer narrative at some point then has to shift. I can't tell you when that's going to be, but on that 5.5, this goes back to, me selling bonds for 13%. I kept telling the pension plans, dude, I know you're a fireman, okay? And you're on the investment committee, God knows why. But let me just do as easy as I can say. If you take that 13% yield for the next 30 years, and then interest rates come down, you're going to make 10 times your money, and you're going to be the hero of the pension plan. Well, we're sort of getting, if we get to that 5.5%, 5.25, et cetera, then to your point, man, I want to, it's a great return, because when rates start to come down, those things are going to go up 20 or 25%. And I don't think anybody really realizes how badly the pension funds got smoked in 2022 on their bond portfolios, and how they're getting smoked this year Silicon Valley Bank had 20 people in their risk management department. You know what I'm saying?
Yeah, I think it's true that at some point you start to see that value in long-term bonds. And of course that intersects with the macroeconomy. Like when bond yields were trading at 13, on the long end, we had gone through 15 years of way above 2% inflation, right? And we were needing 20 plus rates on the short end in order to break that. And the dynamic that we're seeing right now is not anywhere near as extreme. True. In the sense, we had an inflationary impulse and inflation was elevated, but from a macroeconomic standpoint, we're in an environment where growth is softening and inflation has moderated significantly. Will it necessarily go literally back to 2%? Maybe not. Maybe not without a little bit more economic weakness, but we're not anywhere near the sort of dynamics that existed when we had bond yields that were meaningfully higher than what we have today. So this idea that we're going to get to 13% that's being bandied about or something, like it's just that is fantasy.
Well,
right?
That would
because
be
of what it would mean.
black swan event. It would be a double black swan event. That would be, an asteroid crashes into New York City scenario.
Yeah, and I think what I'd say on that is that this is a good time to see how people think about trades and about asset prices, because there's some people who are out there basically saying, oh my God, I think we're going to have a balance of payments crisis in the US and a bond crisis in the US, and yields are going to go through the roof and things like that. And I think the people who are experienced macro traders who are deeply involved in these markets and carefully thinking about risk return opportunities today find bonds a lot more attractive than they did when bond yields were 100 or more basis points lower. And that's the sign of a good trader, right? The sign of a good trader is a person who doesn't get excited about the tail end run, but actually starts to rebalance back when that run happens, right? You want to be fading extreme moves, not levering into extreme moves. And so while, people talking up extreme moves might get more followers on Twitter and stuff like that, like that doesn't make for that's not good asset management. And you could separate the wheat from the chaff right here on who's a good asset manager really in the market today versus who's not, based upon how they're responding.
Yeah, I'm totally with you, and I've harped on this for a while. There are a lot of 35, 40 somethings who've never managed money in a recession, in a bond market, yields going up. And Tina really there was no alternative. You were getting negative returns in bonds. I completely understand. But when the circumstances change, then you got to update your playbook for sure. By the way, as we are speaking, Kevin McCarthy just got thrown out on his arse as the Speaker of the House. That is going to gum up anything that has to do with getting a short-term spending bill, et cetera, et cetera. So that's some new noise in the system. Are you pretty prosaic about that in the looking out 2 or 3 months?
Well, I think that, the possibility of a government shutdown, obviously is a negative impact on growth. And I think it's one of these things that is a little more subtle. Like, a macroeconomist might say, well, you have a shutdown and then people get paid back and it's V-shaped and it doesn't really matter. Yeah. I think it's a little more subtle than that. Particularly from the perspective of, a lot of people got prepared for a government shutdown that didn't actually happen. And now they're looking out and they're saying 45 days from now, the speaker's out of the House. And like, can these people make a reasonable decision? I'm not sure they can. And so that will likely create a level of conservatism for government, employees, as well as the various third parties that serve the government and sell into the government over this period, and also start to erode confidence. The situation, if this was the only thing that was going on and the economy was booming and we were early cycle and the Fed was easing and stuff like that, like no one would really care. Sure. It's more like we're kind of on the edge of a cliff and we have all these little things, student loans push you, and the government shutdown possibility pushes you. And you just all these sort of, and now interest rates rising and now stocks going down, and they're all gentle pushes. But when you're at the edge of the cliff, the edge of the canyon, you don't need that many little pushes to get you to start to move over the gap, and that's kind of what I'd sort of put this into.
Well, the cumulative effect, I understand. My other point would be sort of 20% of the households are responsible for 75% of discretionary spending. 20% of the households own 78 to 81% of all the wealth, et cetera. So if there is this negative wealth effect that you're thinking, particularly if we went down to 3,200, I know I start getting calls from people I haven't talked to in 20 years when that sort of happens. Then there is a feedback loop, to your point. I mean, right. There is the cumulative of it. It's not just one, but there is a negative a feedback loop. And people say, get me the F out of these stocks and blah, blah, blah. And yeah, I mean, it's interesting times we're living in right now, but it didn't really help to kick the Speaker of the House out on his arse.
Yeah, definitely not. And one last question for you, Bob. The UAW strike, it's continuing to move forward. There's now talk about potential the UAW is going to up the ante, if you will, on the strikes at different plants around the country. What's your take? Is it going to have a long-lasting impact on GDP? Is this is this going to be that the catalyst that pushes us into the recession? I mean, what are your thoughts?
Yeah, in and of itself, the auto production it's not a huge impact. It's about 3 basis points of GDP a week, give or take, of drag on third quarter or fourth quarter GDP. So if that happens all 12 weeks, it'll be, enough to notice, but not enough to create a huge drag on the economy. I think I would just contextualize it in the same shape as some of these other things, which is, student loans are going to take 35 or 40 basis points off of growth. And, this could take 35 or 40 basis points off, and a government shutdown could do the same thing. And stocks, bond yields going up could hurt a bunch of different parts of the economy, and slowing housing. And again, all of these things, it's kind of a weird moment. If you go back and look at typical economic cycles, there like back in the 60s and the 70s, it's not like one thing that causes, a total unraveling the way there was, in the 2008 credit crisis. It's like a bunch of things pile up and things slow down, and then stocks slow down, you start to fall, and then that kind of is a little reinforcing on the downside. And it's a little, and then you look back and you're like, well, it's kind of all of these things that kind of piled up and caused a turn in the cycle, and that's basically what we're talking about here.
Well, you didn't wait in any gasoline lines, brother. Let me tell you right now. I remember I had to ride my bike down to the Union 76 station and get in line. So then I could go to the phone booth and call my mom to come down and get some gasoline. That had a very non-marginal effect on our economy. But I'm with you that the cumulative effect here is going down. The other point I would just make quickly, Todd, is that the data that we've worked on says that there's about 93 million Americans who are getting some form of a monthly pension check, be it Social Security, be it, government pensions, school pension, et cetera. And that is one of the reasons why spending has kept up. Do you put that factor in or not?
Well, I think actually a lot of talk about the sort of dynamics where we're likely to have a bunch of marginal things basically drag the economy down. In a lot of ways, we had early in this year a bunch of marginal things that sort of helped pull the economy up. A big part of it was the reset of the CPI benchmarking for things like Social Security that started to get paid, stepwise function paid in January and February. The same thing was true with the tax brackets, which created an effective short-term stimulus, as were the delayed in tax payments that happened in a bunch of the different states like California. You sort of put that all together, and that was kind of an interesting moment where we had a bunch of mini stimulus measures that got us and supported us. Whereas, here what we're looking at is a bunch of sort of mini drags on the economy, and those stimulus measures are unlikely to occur because the inflation measures that we've seen, the reported inflation that we've seen over the course of 2023 will not be nearly as high as the reported inflation that existed in 2022. And so we're not going to get anywhere near the sort of benefits that we saw flow through in early 23 to occur again in early 24.
Okay.
Todd, I'm going to get that recorded and download that, because there was really a lot of smart stuff he said there.
Oh, he's brilliant. Bob's definitely brilliant, no doubt about that. Well,
I appreciate that.
The September jobs report's coming out on Friday. It looks like Wall Street consensus, I believe it's 165,000 unemployment rate, dipping to 3.7. What are your numbers?
I mean, I don't call specific macro reports because, to be honest,
another reason he's smart, Todd.
Anyone who thinks that they have an edge in calling the report, that's not true.
There you go.
No one has an edge in it, and people are incentivized for outlier positions in order to get headlines the few times they get lucky. 160,000 jobs seems about right. Unemployment rate still in the threes, but we're sort of meandering up, seems about right, triangulates with the other data that we're seeing, which is that there's been some softening of employment, but we're not quite yet in a situation where we're seeing meaningful declines. And basically all the data that I see is aligned with that. And so the jobs report will either be consistent with that or will probably be a fluke outlier if it's not.
Okay. Well, I would just, Todd, I would just add this, that, you know, when you have 9.1 million jobs available, and you have 4.3 million people actually available to fill those jobs, and about 2.5 million of those jobs actually require you to know something. That secular mismatch is not going away unless we go down to Venezuela and bring up 700,000 people. And so that is the stickiest number of the of where the economy that we have going. You know, the housing shelter costs are 41% of the CPE if you add in mortgage rates and rent rates and lease rates. And then my favorite, the assumed what I can rent my house for number, which to me also is complete horsepucky. But we're not going to get a much lower number on that. That's not going to bring our inflation rates down either materially. So I'm just afraid. Todd, I'm just saying is that what no one's talking about is what the Fed really has to do when you have 2 jobs for every 1 employable person. And what the Fed had to do if they wanted to get to this miraculous 2%, which I don't believe they should ever do again because the geopolitical world has changed inflation. Yeah, they got to crush the damn economy. They, you know, this pussyfooting around is just like you're at a shell game and somebody just keeps going around and around. The only way we would get to 2% would be a material loss of jobs. And the only way we get a material loss of jobs is in the service business because that's 75% of our economy. So you can smoke the cars, you can hit the houses. There's a lot of circular effects. But until you lay off about 2 million service workers, how the hell do we get to 2% inflation? I don't see it.
It's a good question. I don't know, and the only time will tell on that one. And that's definitely a further discussion for another show. But we're going to close it out there, guys. So, Bob, thank you so much for joining us today.
Yeah, thanks for having me.
So you were sensational. You were great. I know our audience is going to get a lot out of it. So,
Todd, I'm doing all of my things from outside now. The rug cleaners are gone. I live on a golf course. What am I doing it in my office for? I don't know.
I thought there was a tornado or something. I thought the roof was taken off. I see your whole screen changed. So that's great. Glad you're okay though. So I like it. I like the look. I know that the viewers will like it as well. So on behalf of Bob Elliott, CIO of Unlimited Funds, go to unlimitedfunds.com for more information on what Bob has to offer. HFND. There you go. So on behalf of Bob Elliott and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by Crosscheck Management.
If you like Buy, Hold, Sell Live, be sure to smash the like button.